Every day, I'm getting bombarded by these questions from friends. One's wondering whether the market has bottomed or not. And this person really wants to invest in gold. And Arjun is worried whether he should stop his SIP. But I think she's just scared because, the market could fall even more. I know during Corona, the market fell 38%. And now the market is down only 13%. I think the question you're really asking is, should you invest right now or should you just exit? Actually, let me show you a chart. This is Nifty in 2024. It goes sideways, it goes up, falls a little bit, goes up. It was a beautiful bull market. And this is what looks like now. For 5 months, the market has been falling. Some people calling it a crash, some people saying a recession may happen. Why did this happen? To understand this, you have to zoom out. Look at Sensex from 1986 to 2024. You'll find something you've never seen before. In 1986, we had the mounting fiscal deficit, which caused a 41% fall. There was a balance of payment crisis in 91, which is minus 39%. There was the Harshad Mehta scam, decline of 54%. There was a dot-com bubble in the year 2000, which was minus 56%. We had a 2006 market sell-off. There was the global financial crisis in 2008, which was a 61% fall. And of course, very recently, we had the coronavirus pandemic, which was minus 38%. Now, the problem is you're not an economist. You're not a research analyst. You're not a hedge fund trader with some algorithm which can tell you what stock to pick and choose. You're a retail investor like you and me. And I think we need a basic economics lesson here. The economy is dynamic, and so are the markets. Markets move in cycles. Basically, markets don't move in like a straight line. Like in the last 5 years, Nifty has given returns of about 15%. And then you'll see phases like this, when there is a fall of many months. In fact, in some cases, these falls can be as steep as 39%. And that's completely normal. But if falling market is normal, then everyone should be investing, right? But the shocking truth is completely different. Look at this. This is the SIP stoppage ratio, which basically means how many people have stopped their SIPs. Look how high that is. You'll notice when the market falls, people get fearful and they stop their SIPs. But as the market is rising, people won't start investing immediately. They need proof that the market is safe. So unless you start moving up a lot or make new highs, people don't really start investing more seriously and regularly, which means we are going to play the market through the eyes of fear and not through the eyes of logic. The advantage of a falling market is simpler than you can imagine. Every time the market falls, it's actually a gift for the long-term investor. Let's suppose you invest 10,000 rupees every single month, no matter what happens to the market. And simply by doing this on this Excel calculator, which I've given you in the description, you can do this for yourself, change that number, you'll see an XIRR. This is basically returns. The returns for this is so much. But what if I stopped my SIP when the market fell? What would happen to this return? Let's find out. So I'm opening the SIP over here, and every time I notice the market fell, jaise ki March 2020, if I scroll back to March 2020, I can actually delete this 10,000 rupees and everything will change. Now I'll do this for all the falls in the last 4-5 years and see what happens to the XIRR. The returns are now drastically less. You know why? Because every time I invested, I only invested when the markets were going up. When the market fell, I could not average down. So the summary is, you should not stop your SIP. But the question still remains about lump sum. What about people who want to do a lump sum or people who want to invest in particular stocks and that portfolio is really down? Here's what you should do. We'll look at 2 data points and then I'll talk about how you should interpret those data points, okay? The first one is on a chart. This is Nifty 50 index and I'll put 3 moving averages. The first moving average is the shortest moving average. This is, as you can see, your 30-month moving average because we're on a monthly chart. Then is the most interesting, the yellow moving average, which is a 100-month moving average, which means every 2 years, 1 data point gets collected. And then we have Beechka, which is 50-month moving average, which is 1 data point every year. And when the market comes here, it's really fairly valued. Now the problem is we are pretty far away from here. How do you know, will the market come to this moving average or this moving average or this moving average? This is a question mark and I'll answer this question. But we have the second point over here, which is the Nifty price to earnings ratio. It's very simple. Look at just the blue line over here, okay? So the blue line over here at 42 shows that the market is very expensive. And when the blue line comes down, like over here 18.92, the market is like fairly cheap. So how do you know what is fair? Well, the long-term average from 1999 to 2025, the current PE ratio average is about 20.82, the median. And the market is at 20.38. So is the market fairly valued? Here's how you interpret both of these data points. I'll tell you through the story of 2020's market crash of Corona. So if I look at the technical chart, during Corona, the market touched blue and touched yellow. Fine. And then when I opened the PE ratio around 2020 is where? Here. The market was then priced at 25. And I knew the long-term average is 20 or somewhere around that. I think it was 18 at that time. So I thought 18 is average, market's at 20, market has crashed, the world is crashing, the world is burning, sab khatam ho jayega. So I should wait for the market to be fairly priced. Therefore, I stopped any investments and I waited for the market to fall because logically speaking, looking at all the data, the market should fall, right? And this was the biggest mistake. Nobody in the world, including the biggest investor and the new rookie, know what the market is going to do. No amount of analysis, no algorithm, nobody knows. Kisi ko nahi pata. All of these data points is to basically tell you, all is well, sab theek ho jayega. You don't have to do all of this. Maybe knowing this makes you feel secure, but the safest thing to actually do is just do a frickin' investment every single month. And if the market falls a little more, maybe you can do a lump sum. But trying to predict how much the market will fall, even I couldn't do, and I've been trading and investing since 2007. Nobody knows this. The reason I showed you this is when you show a lot of data, people think kuch intellectual baat hogi and something interesting will happen. But I'm pretty secure to tell you, all of this is nice to hear and it's good information, but it can never predict the market. Shut up and learn to invest every single month for the rest of your life. You can thank me later.